Hi there, welcome back to ET Now. You're watching Midcap Masala with me, Kanishka Sarkar and Srishti Sharma. Well, time now to focus on another mid-cap company, that is Cantabil Retail India, which reported its results, and it's largely been a decent quarter for the company. Though profits have seen about a 3% increase. Meanwhile, revenue, that's all good, 16.5% uptake. So yes, let's connect with the management and find out what happened in the quarter gone by and what's the outlook going forward. And for that, we are now joined by Shivendra Nigam, the CFO at Cantabil Retail India. Hi Shivendra, thank you so much for joining us today. Well, let's firstly talk about your EBITDA margins. They've seen a good expansion of more than 100 basis points on a year-on-year basis to that 23.9% level. So tell us, what were the key levers this time around, and how sustainable do you think this kind of growth is for the quarters to come?
So thank you. First of all, thank you very much for having me on the show. So yes, we have continuously working on our EBITDA margin to improve. So the result is there on an annual basis. We are targeting to reach this EBITDA margin in approximately 28 to 30%. So this quarter is probably the most lean quarter for the business and for the industry as well, right? But post GST from 22nd of September, a big boost has been given to the economy as well as the business as well. So we are looking for a more improvement in EBITDA margin, and overall target to reach at a 28% to 30% of EBITDA margin is there, and we are going to achieve it.
All right, we'll talk about more in detail that what will really help you achieve that margin guidance for 2027. But before that, Mr. Nigam, despite the higher revenue and the volumes, the sales per square foot did fell by almost 2% on a YOY basis. If you can help us understand the factors behind it and what steps are being taken to improve the store productivity?
So we are now opening a bigger store. For last 1.5 years, we are opening the bigger stores. 2 years back, our average size of a store was approximately 1100 square feet. But for last 2 years, we are opening the store approximately 1700 square feet. So now our average size of the store is 1350 approximately, 1300 square feet for the store. So theoretically, once you increase the size of the area theoretically per square feet comes flat or slightly on a euro downside. However, on an overall basis, my EBITDA has been improved because my rentals are fixed, my salaries are fixed. The moment I double the stores or I increase the size, overall EBITDA level has been improved. So that will be, the company in the line what we are operating, we are having a high number of SKUs, whether it's a casual or whether it's a formal wear. So we need a bigger stores. So for last 2 or 2.5 years, we are opening the bigger store. So theoretically, it would be flat. However, on an annual basis, we are committed and we will be able to achieve our annual target of approximately 800 rupees per square feet.
Right. Shivendra, since we are talking stores and margins, now you do aim to reach that 725 stores level and EBITDA margin of 28 to 30% by FY27, if I understand correctly. So take us through what are going to be the strategic enablers to achieve this kind of growth, and any key risks that you're spotting at this point in time in terms of execution?
So the growth levers are clear. We are adding areas. So in last 1 year also, we are added approximately 1.5 lakh of the square feet of our retail expansion. So this year also, we have added approximately 32, 33 stores for the first half. So overall target to adding these 60, 70 stores is on the target. Last 1 year, as I just mentioned, 1.5 lakh square feet of the area we have been added, and going forward also. So this year, by this pace, we are definitely going to cross approximately 20% plus of revenue growth. And this 28 to 30% or 28, 29% EBITDA this year. And going forward, also you will be able to see more improvement on these numbers. So FY27 target by this pace is very clear. We are crossing 1,000 crore of revenue with approximately 30% of the EBITDA margin. The levers would be expansion, retail expansion. Same store sales growth is on target, 7 to 8% of the same store sales growth. E-commerce is expanding now. That is giving the good revenue. So these are the key drivers: retail expansion, square feet area, same store sales growth, and e-commerce would be able to achieve this.
All right, but Shivendra, in terms of the product mix and your offerings, we believe that now more focus will be on the women's and the kids wear. How meaningful can these segments be in your overall revenue mix, especially in terms of the margins? Are the margins in these segments expected to be a bit on the higher side versus your consolidated margins?
So overall consolidated margin for the company as a gross margin is important for us. So 58 to 59% we are operating on a gross margin level. Even in the menswear, now we are increasing the women's and kids wear as well. 55 exclusive outlets have been opened already for the women's and kids wear, apart from family stores of approximately 210 odd. Going forward, also the expansion would be family wear stores as well as kids stores. As far as margin is concerned, we are operating in all the categories, whether it's a men's, whether it's a women's, or whether it's a kids. We are operating 55% plus gross margin in all the segments. So overall consolidated margin for the company is going to be maintained approximately 58 to 59% or 57% going forward on an overall basis. And all the categories are giving us the 55% plus gross margin.
Shivendra, in your commentary after the results, you did mention that you're seeing early signs of demand recovery and ongoing investments in product innovation and store expansion also. So tell us, how confident are you of maintaining this double-digit growth that you have seen, while protecting margins, of course. You did mention that it's, a cyclically weak quarter as far as the second quarter is concerned, so it's likely that it's going to be better anyway in terms of growth. So if you could give us a target that you're looking at, in terms of revenue growth alongside protecting margins.
So as I just mentioned, we are continuously working on last, if you see CAGR, we are growing approximately 16 to 17%. But going forward, 20+% of the revenue growth would be able to see this year. And by this 20% plus growth, we will be able to cross, as I just mentioned, 1,000 crore of revenue. And whenever we are mentioning any number in any of the commentary, these are the numbers without compromising any of the margins. So for us, very important to maintain the gross margin. On a consolidated basis, this would be 58 to 59% approximately. And by this, because the costs are fixed, my EBITDA margin are going to be 28-30, or even on a longer term, we are expecting it to a stable 30% EBITDA margin. And whatever the number we have been mentioning in our earlier commentary and going forward and as of now, this is all long-term sustainable numbers.
All right, so long-term sustainable numbers, that's the word coming in. Thank you so much, Shivendra, for joining us today and taking us through the outlook for the company going forward. We wish you best of luck.
Thank you. Thank you so much.
All right, then.